everybody, to this edition of Private Credit in the News with Hao and Chris. Seems like this is all we talk about. You remember a while back, Hao, when all we talked about was egg prices?
Yeah, this is our new egg.
This feels like the same thing, right?
Yeah.
It's all we talk about now. So, private credit's in the news, but actually we've just been getting more data, and so we wanted to address it. In addition, there's been a couple of CEOs that have come out and talked about private credit. So Larry Fink of BlackRock has come out in his annual shareholder letter, and he just had some comments on private credit. We also got some third-party research and reporting, which starts to show us things like redemption requests and non-accruals, which is like defaults. And so we thought we would chat about that on today's call. Franklin Templeton, CEO, also came out and had some comments to make. We'll wrap up that section, and we'll talk about Allbirds. Remember the shoe company? The failing shoe company? Everybody had a pair of Allbirds.
That uses recycled materials to make shoes that lasted, 2 months?
I still got a pair that's been around.
You actually bought a pair?
Of course I did, yeah.
Okay.
Did you not?
No.
You're closer to Silicon Valley than I am. What's wrong with you?
Because you're paying how much for shoes? I buy my shoes at Costco
No,
for like $10.
No. When you got a successful product when Amazon starts knocking it off. So Amazon was doing these like fake Allbirds for a while, and then you had these other companies come out and make similar products. So
yeah, Costco never put Allbirds on sale, so I never really thought to buy a pair.
Okay, whatever.
As you can see on video, I'm pretty stylish.
Anyway, so Allbirds, they expanded, and now they're expanding into AI after the shoe business failed. Stock was up like 600% of the news. We just think that's hilarious. And the last one you threw in here last minute, I did not see this.
The state of Maine, bans large data centers. They just passed a law.
Yeah, I wonder if that's going to be more to come.
Yeah.
All right. Let's dive in. So Larry Fink came out of BlackRock, and what we just wanted to highlight here is he commented on private credit. So he said, there's been a lot of attention on private credit, but the headlines do not reflect what the clients are telling us, what our portfolio data shows, or where we see the market going. He goes on to say demand is structural. Private credit serves an important role in the financing system. Banks, governments, public capital markets can't fully address the world's growth and investment capital needs. That isn't changing. Basically saying private credit is not going anywhere. He did comment, and we'll comment on this more here in a little bit. He pointed to a growing gap between the performance of private credit funds, and we're seeing that too in the data. Some managers are doing just fine, really. Some managers are really struggling. That seems pretty normal, right? You expect to see some dispersion of that. Larry comments on that too. And so we'll unpack that with some other third-party data that we got. What's your reaction to his comments here, and was there anything else in the letter that you thought was interesting there, Hal?
Yeah, it was he jumps into the firm that they bought, HPS, which got relabeled as BlackRock Private Credit. They notably had 2 cases of fraud where they lent money to people who were just made up their profit numbers or their value numbers, right? I don't know the full size of the book, but I'm pretty positive that there were hundreds of loans versus 10, right? So big difference in default rates, right? You're a credit card company, you're going to have people who can't pay their credit cards. This is probably the oldest form of money lending, right? There's no intermediary because that's why they call it direct lending. You're directly loaning money to someone. And if you do it in some cases, 1,000 loans or so, there's going to be defaults, right? And it's your job to control the percentage of defaults to keep the loan portfolio from sinking on you, right? And people don't view loans like that, which is, I don't know, hard to believe, but also I guess we can believe it because loaning out money is through bonds, through banks, through other financial intermediaries. This feels new, but this is probably the oldest form of lending ever, right?
B-Debt was one of the ones that was in the news, and I just want to play off your point there. BlackRock's debt fund just kind of missed the mark on a few, and so I'm just grabbing the news here. The fund had the shares dropped, and it's because they had to write down a couple of these loans. I want to tie all this back to Jamie Dimon's comments, where when all this started to come out, Jamie Dimon said, now maybe somewhat famously, when there's one cockroach, there's probably others. And if you then listen to what he said more recently on JP Morgan's earnings call, it's more apparent that he was specifically referring to fraud. So I think what is, private credit's in the news a lot because of potentially deteriorating underwriting standards. No one knows what they own. And then also AI eating software companies, and software companies are between 10 and 30% of these funds, right? So oh my God, what's going to happen, right?
Yeah.
But he hasn't commented on that. In fact, not a lot of these CEOs are commenting on that more specifically. They're saying, well, there could be fraud. There's fraud in the system always. It's just how much of it. And that seems to be what his cockroaches comment was, which I do think is notable. He wasn't saying the whole asset class is blowing up. He's saying there's probably some issues.
But what's the better headline, right? So it helps to understand what financial media specifically focuses on where the negatives get more clicks. Mm-hmm. Versus if Chris put a headline that says Jamie Dimon says that the whole private credit space as a whole is relatively healthy because, a small number of loans defaulted. Would that generate any interest? Or there's fraud in the system without really saying how much of the percentage is. And I think that's what the private credit managers are fighting. Mm-hmm. To be fair, they grew very fast. They see high fees, and JP Morgan, one of them, right? They recently launched, relative to everyone else, recently launched a private credit fund, which charges a pretty high management fee. These vehicles do charge more than the index, and I guess it's no surprise that we saw a big rush of new managers come in. And I think that's probably part of the problem was it grew too fast, the asset class did. When you're lending out money to people, anyone who needed to borrow was already borrowing, at least from the established players. But when you have growth of, let's say, hundreds of billions of dollars, that has to go somewhere. That has to get lent out to someone. So what are you going to do? Lower your credit standards.
That's the theory. Yep.
But again, this space is opaque. And we're not here to bash it or defend it completely, but the space is opaque. We don't know how large the direct lending market really is, right? The bond market we can measure, right? That's how many bonds outstanding. The direct lending space could be as simple as me loaning money to Chris. That's direct lending. That's a private investment from my part. Pension funds are invested in this. Endowments are invested in this. Sovereign wealth funds. Insurance companies, banks, all invested in direct lending. Why? Because I think it's more direct. You don't need an intermediary, especially if you're an insurance company with billions of dollars to loan out. You're just going to loan out directly and save a ton of money on underwriting. Does that mean the credit quality is bad? No, not even close to being bad. Because what if you're a relatively large-sized company that doesn't want to sell bonds? Well, you're gonna probably take a loan out from an endowment, a pension fund directly, because we're talking big numbers, and you don't need the middleman in a lot of these cases. That's direct lending. It's private credit, but the headlines are suggesting that these blowups are, I don't know, systemic through the entire industry, and I think that's where the headlines really mislead people.
I think that's a valuable point because what we're zeroing in on here and what I think we should be focusing on is private credit in the sense that we're describing it here. These are leveraged loans, typically to private equity backed companies. Yeah,
which is a subset to private credit, though. Like it's
yes, yeah. And that's the point you're making. And I want to be clear that the loan structure and why private credit pays so much is because they're lending to companies that don't have Microsoft level credit quality. But also a form of private credit is, say, XYZ insurance company buying a bond or issuing a bond, buying a bond from Amazon or this type of thing, right? So that's a private credit transaction.
It's a direct,
it's not,
yeah.
It's a direct loan,
Yeah.
but it's not a leveraged loan, which is a different structure.
Yeah.
And so what we're focusing on here is this leverage loan structure, which is then lending to companies that, maybe yesterday had $100 billion value, but today Claude ate them. And so now they have a $10 billion value. And oh my God, what happens to the debt? That's what we're trying to focus on here. More recently, in Hao's point, is that the headlines have gone beyond that and incorporated in and included all forms of direct lending, which makes the space feel massive.
Yep.
So I think that's interesting. And, we'll see how this continues to unfold. But, I think this should be mostly just focused in on the leveraged loan section. That's the section that seems to be in question.
Yeah. Admittedly, that is higher risk.
Of course.
But even the risk in that subset, right? We're looking at what's called a non-accrual. We're looking at the inability to pay overall, right? Sometimes the interest gets tacked onto the principal, or you can't pay your payments back at all. But we're still looking at sub 1%, right? 0.73.
Yeah.
Like it's still a very low percentage. Things can change. Yeah, something can disrupt such a large part of the borrowing, but I don't know. It doesn't look like the numbers don't play out the way the headlines are suggesting. Not even close.
At least not yet. And so let's go to Franklin Templeton, and then we'll go to this report. So
Okay.
Franklin Templeton CEO Jenny Johnson came out and said, private credit sector has earned its rightful place on Wall Street. Private credit is here to stay, which she was talking in an economic summit recently. She tethered her argument to the 2008 financial crisis when tightened capital requirements forced banks to stop lending, prompting private funds to fill the gap. This is something we've widely talked about, right? And so, private credit started to really balloon since 2008 because a lot of the regulation went in to try to strengthen the banking system and then insert these other private funds to provide liquidity and capital to, companies in need. Johnson also pointed to artificial intelligence and enterprise software as the next frontier, a contrarian view on Wall Street. Software stocks have been pounded because of fears that rapid AI advances will make traditional software obsolete. Part of the concern surrounding private credit has also been their ties to lending to software firms. So I think that's interesting that we're starting to see a lot of CEOs come out and basically say, hey, headlines, we're not seeing it in our data yet. That's not us making the call on all clear green light. I would say that we just don't know yet. But the point is, this is definitely being met with data that these CEOs and insiders are seeing, and they're saying, look, we aren't seeing a massive spike in defaults.
They're not in the business of selling newspapers, though, right? So they're going to get a lot less clicks than the ones that say, hey, there's fraud here. Mm-hmm. Well, if one company is fraudulent out of thousands, is that news headline worthy? I don't know. That happens all the time, right? Yep. Do we really need to pay attention to that? Eventually, maybe we do, but it just seems so the sky is falling type of mentality versus write about something else. Maybe there's nothing else to write about, but I find it hard with this administration and things going around the world to write about, but here we are.
All right, so this is some third party, essentially some aggregated data that we got a report on, and so we want to just talk through some of this. So this is as of Q1, it's basically March 31, and a couple things that I would call out here. So in terms of the risk side, so things like Chapter 11 bankruptcy filings or BDC, so that's a business development company, which are these non-traded companies that they price once a month. This is these products that people are allocating money into. In terms of Chapter 11 bankruptcy filings, we've got a long-term average, we've got a 1 year ago data point, and then we've got a most recent data point. And it's ticked up. No surprise there. So it's ticked up. Not by a major amount, but it's ticked up a little bit. The other one here is the BDC default rate. So this would be non-accruals, these loans that are stopping paying. So, they're getting closer to defaults. It is important. Technically, default is different than non-accrual, but I'll just roll with this for now, just for the purposes of this discussion here. We've got a long-term average And I'll say about 2% or so is the long-term average. The 1 year ago data point, maybe somewhere in the neighborhood of 1.5%. And the most recent ticked up to maybe 1.6 or so. And I think that's notable. By the way, this data point is as of 12/31/2025. I should mention that. So it is delayed. But according to that data, yes, I know in the comments, everybody's like, but so much has changed. Yes, I get it. But as of 12/31, we haven't seen major movement yet.
Yep. And those fraudulent headlines, maybe I should reword that. Those headlines pointing to fraud were around that same window, late last year or so. It does coincide with some of the call-outs that I forgot the name of the company. I think it was Greenfield or something that was found to be fraudulent. That was late 2025 as well.
Yep, good call. So that's in there. Yeah, there was Tricolor.
Tricolor, yeah.
And then there was, now of course I'm forgetting on the other one, but yeah, there were those two auto industry brands, interestingly enough. It wasn't software. We're looking at the wrong thing, guys. Okay, so then the next piece here is the fundraising, so money coming into these funds, and then the redemptions. And what's notable here is I've got a chart going back to Q1 of 2021 and closing as of 12/31 last year. So we actually saw heightened redemptions as of 12/31, but redemptions were zero through all of 2021. They only started to pick up. There is a little teeny tiny line on my screen in the first quarter of 2022, and then they've kind of oscillated a little bit. But still, the net inflows are still positive from an industry standpoint. So I want to just make that clear distinction. By the way, this is across 23 non-traded BDCs. So this is going to be your Blackstones and your Ares and your KKRs. These big funds that own a lot of this market space. You're still seeing net inflows to the asset class. It has come down from its all-time high. I would say it's about a third in terms of its total net. And we have definitely seen some outflows. But if I'm looking at this most recent quarter, Q4 25, inflows were 10. I'm guessing that's 10 billion. Outflows were about 5 billion with a net of about 5. So again, we'll get this updated every quarter, but so far not seeing significant outflows. Yes, outflows have been higher, but it's not been like the entire asset class is outflowing. Do you have any other thoughts on this one here?
I don't. Yeah, where's the money coming from? Mostly the people jumping into this now are probably opportunistic. Again, there's stress from I guess the outside in this industry, right? Media, redemptions, which we'll talk about, but it just seems like relatively the smart money is broadly jumping in here versus retail driven demand.
You know what I think this is? So I think that you're seeing redemptions in only a few different BDCs, and Blue Owl is at the square of this. We talked about this on the last pod. They had their couple of publicly traded funds that had just these massive redemption requests, right? And so I think these redemptions are mostly concentrated in a couple of products, and that the inflows are actually going to other products. So maybe it's going from Blue Owl to Blackstone, hypothetically, right? So it's not that the total allocation of dollars has significantly decreased, but the outflows and then the inflows are kind of going from one pocket to another.
Yeah, that's probably true. And maybe, hopefully, the lesson learned here is going after the highest yield isn't always the freest lunch, right? Like there's risk that comes with it. Again, if you think it's low risk coming into something that pays 10%, you probably are in a mismatch of the investment. But if you go in thinking that, hey, there's relatively high risk, higher rate of default, and you still like it, and you feel you're being compensated for that risk, that's a pretty decent investment, in my opinion.
I agree. So, all right. So next one here is discounted loans rise, but not a lot. And so what this is this is a markdown on the loan. So if you own a loan, you own it at par, $100, and then if you say, you know what, I'm going to lower my credit standards on this loan. I think the company's under stress. They're still paying, but I'm going to lower my credit standards. I might mark it at 0.9. So I might hold that loan at $90. And then maybe if I see more stress, maybe I then hold it at 0.8 or 0.6 or that kind of thing. So it's a way of valuing the loan to try to estimate, hey, things aren't going so well with this piece of debt. And ultimately, if the company goes bankrupt, we're going to claim it and try to recapture our debt as much as we can. We're going to make an estimate that we can recapture 70 cents on the dollar of what we've lent out. Okay, so hopefully that makes sense. So what we can see here is industry-wide across, again, all these same BDCs dating all the way back to 2023. And if you look just strictly at the number of loans that are marked at below 80% of par. So that signifies pretty high stress, right? That's like, hey, this loan is probably not going the right direction. So I'm holding it at 8.8 value. Increase from 230 loans, a mere 230 loans, back in Q1 of 2023, all the way to 1,160 loans here at the end of 2025. However, if you contrast that number with the overall growth of the asset class during that same period, you still are in range. So in terms of percent, it was roughly 8% of loans back in Q1 of 2023 that were marked below 80% of par. As of Q4 2025, that number is 11%. And it's actually oscillated between 8 and 11% really this whole time, with the high being 11 right here in Q4. But it's been at 10% a bunch, it's been at 9% a bunch, it's been at 8% a bunch. So I just want to call that out too, that the asset class has grown a lot. In fact, the number of loans here is like 11,000 versus maybe 380 as of 2023. So significant difference. Nope, sorry, I said that wrong. 11,000 loans today versus about 3,000 loans in Q1 of 2023. But that, again, at least as of current standards, we haven't seen significant erosion in the credit quality standards that these lenders have been lending out, because that should translate into a spike in defaults, which we just haven't really seen yet. Anything I missed there?
No, that well cited and well summarized.
All right, last point here is just on non-accruals. So it seems like non-accruals remain contained, and it seems like it's a handful of managers that are having this issue. So the weighted average, and non-accrual means company can't pay that month's interest. So you mark it as a non-accrual. So non-accrual rate for BDCs declined to 0.66% in Q4 of 2025 from 0.73% in Q3 of 2025. So actually got a little better, remaining near historically low levels. At the manager level, outcomes are mixed but stable. And this is something that I know we've beat the drum on, which is managers really, really matter in private market space. If you're buying an ETF, you can buy the Vanguard ETF, you can buy the iShare ETF, you can buy the Fidelity ETF, you can be the Schwab ETF. If all those things are benchmarking against the S&P 500, you're going to be very, very tight tracking with all those different products.
Yep.
But if you're buying private credit and you buy 5 different managers, you will have a different experience across those managers. The managers really, really matter here in the private market space, really across everything, including private equity and real estate and everything else. Okay, so it's come down a little bit and it's remaining very near historic levels. At the manager level, however, outcomes are more mixed but still stable. So of the 46 funds that were looked at in this, 14 of those funds saw increases in non-accruals, 12 funds got better, and 20 had no change at all. So that's highlighting just the dispersion of managers without saying broadly there's a lot of credit stress here. Look, all of these managers loan to software companies, if that's what we're zeroing in on. Some have had improvements, actually. Most were unchanged, and some actually did see issues. So I think ultimately that's pointing to the current market behavior really seems to be quite normal. And we'll wait for more data on this, but we haven't seen the significant stress pop up yet that is being pointed to in the media.
Yeah, all about selling papers, right, Chris?
Well, I'm just
Or
saying,
generating clicks here.
I'm just saying we haven't seen it yet.
Yeah.
All right. Maybe we can be done about this topic, but I hate to say it, we're not going to be done about this topic for a while.
No,
We're gonna
things
keep
will
this-
change. If it gets worse, we'll definitely let everyone know. But it just doesn't play out in the data.
Not yet. We haven't seen it yet. Okay. Allbirds.
The shoe company.
What are we doing? What are we doing? Okay. Allbirds pivots to AI. Positions itself to be really the next CoreWeave. The stock was up 640% on the news. What can go wrong? Probably nothing. So,
Chris, you remember that drink company that changed its name to like something crypto, and then it popped in a very similar fashion? Mm-hmm. I don't know
Long
how
Island
dumb.
Iced Tea Company. I have that here in the deck. Yeah.
Iced Tea Company. Long Island Iced Tea changed its name to blockchain. Oh, they added the blockchain label to their name. I don't know how dumb money still has money at this point. It feels like this Darwinism isn't working as fast as we'd hope in the investment sphere, or it's either that or they keep finding ways to borrow.
Man, so this is just one of those so Allbirds sold their assets last month for $39 million. That's like nothing.
Yeah.
Unbelievable that a company like that could sell for that.
This was a stock that peaked, $520 a share in 2021.
At their heyday, $3 to $5 billion valuation. Now, granted, it kind of IPO'd and just went straight down, and was in the $400 to $500 million range for a long time, and then ultimately sold. But man, talk about like just intellectual property getting sold there. So along with the sale, they sold their name, so they couldn't call their new company Allbirds. That was part of the brand that sold. So now the company is going to be called, you guessed it, Newbird. Newbird AI. Newbird
You forgot
AI.
the AI initially, yeah.
AI.ai, because then it's worth more. So fully integrated GPU as a service and AI native cloud solutions provider, the company announced via its insider relations site. This just reminds me so much of, yes, blockchain, but also the .com thing. Remember when companies would just add .com to their name?
Yep.
This was in like 1999, 1998, and then boom, they would just go up.
Yeah,
This is wild.
it's crazy that the patterns keep reemerging, but this is only 4 years old at this point, 4 or 5 years old. And for it to come up again and people haven't learned their lesson is just really bad.
The rebranded AI company also announced a $50 million investment. That's a lot of money when you sold your other company for $39 million. A $50 million investment from an undisclosed institutional investor. Who was that?
Private credit.
I'm kidding. Private credit. It was Blue Owl.
Yeah.
It was Blue Owl. Oh, geez. I mean, is it gonna be like CoreWeave or somebody? OpenAI is the one that.
No,
does
it's
it.
another shoe company. It's like Adidas or someone that.
No, dude,
that
it's not
has nothing-
shoes. It's not shoes. It's AI.
Oh yeah, I forgot. They changed their name, so they're not a shoe company anymore.
They're not a shoe company anymore.
Yeah.
You forgot so quickly. They're an AI company now.
Yeah.
Anyway. So I don't know what that means. Okay, so objectively pretty funny that Allbirds is becoming an AI company, not because it's unusual for companies to pivot, but because of how extreme the pivot is. Because, they made shoes, and now they're going to be a provider of GPUs. Somewhat absurd, kind of risky, and
Imagine running a company and you're like building a data center and you fill it with Allbirds built servers.
you better be wearing the shoes. But
Yeah.
either way, I mean, it just seems so silly to me. Like, is this a pump and dump strategy? Like, how much? I want
It
to
has
see
to be.
insider trading activity on that day.
I can't imagine anyone wanting this as a service.
I bet
from,
Nancy
from this
Pelosi
particular
bought it.
company.
She probably bought the stock and then she sold it at the high.
Well, the number of politicians disclosed trades is pretty wild, and
It's a whole nother episode.
yeah.
Anyway, so that's it for that. I got nothing else to say. I just saw that in the news because it popped up on my hottest stocks of the day, and it was up 600%. I think it was up almost 1,000% at one point. It finished up maybe 300% or something
Yeah.
like that.
Before the pop, it traded $2.50 a share, down from 520,
Yeah.
and then it goes up to $24 a share. Massive increase in a single day.
Yeah, 250 to 17, and it's up another 5.5% today. So, yeah, I don't know what to say about this one.
Ignore it.
Fair enough.
Yeah, don't add it to any watch list. Don't even have an inkling to jump in and get out before everyone else, or that you're smarter than anyone else. It's just the move's been made, and it seems like it's going to go down from here. But don't take that as an investment advice. Don't short the stock. Don't do anything with the stock.
It's comical. It's comical. Yeah. Okay, let's move on to the main thing. I had not seen this, so I want to let you take this.
Maine, the
with
state.
Data centers.
Yeah, not the main topic, but like Maine, the state.
Yeah.
It is the first
After that,
first to pass. Yeah.
Not our main topic.
First state to pass a statewide ban on large data centers. So if you are planning to build a data center that draws more than 20 gigawatts of power, will be banned at least until 2027. So Chris and I, this has been a recurring theme too, is like how data centers are encroaching on a lot of spaces, not just from the build out, but like the square footage, but the noise, the energy usage, the water usage, all kinds of things. And what once was a sought after, I don't know, addition to in a community, especially when jobs are just not growing, typically in rural areas, in rural parts of states, people are more than willing to add data centers that are tied to Microsoft, Meta, Tesla, you name it, with the hopes of jobs coming. But they didn't think about the other impacts, right? Specifically, energy prices jumping up pretty high. Some areas like 220% increase in electricity rates. Virginia is probably the biggest state that welcomed data centers, and this sentiment really shifted, right? A survey in 2023, 69% of Virginians were in favor of data center build-outs in their state. In 2026, 35%. So 50, it's cut in half, essentially, the number of people who are comfortable with building a data center in their state. Right, so this is a survey of over 1,000 Virginia registered voters, but again, not a massive sample size, but the sentiment really shifted.
I wonder if this is just kind of a intro bill to like see where this goes, because a 20 gigawatt data center is huge. Okay, so a 20 gigawatt data. So most of these
build
are
one
10.
That's 19 gigawatt, and you're set.
But that hasn't even been done. So look at this. I just threw this into Google. To visualize the magnitude of a 20 gigawatt data center, consider the following comparisons based on current power generation. The amount of power is equivalent to 90% of the UK's total power generation capacity. One 20 gigawatt data center.
Oh, so it's more symbolic.
UK. Regional demand is roughly equal to, or just as a point on regional, roughly equal to the total power generation of the capacity of France. And from a nuclear power plant comparison, a single typical large nuclear power plant produces about 1 gigawatt. So you'd have 20 of those. We're talking about something that is the size of 700 American football fields or 40 million square feet.
Or enough to power a time machine to send you to the past, right?
Well, so
Back to the Future reference.
Thank you for that. So, I mean, my point is like this could be a total nothing burger, or it could be like, all right, we passed this law because we don't want to build these massive things, but the goal is, of course, to like kind of start lowering it over time to, protect what you just said, which is these things are loud and they take a lot of water and whatnot. They create jobs until they're built, and then they create no jobs, right? Anyway, we'll see. I think that's interesting, but my current read on this is it's kind of a nothing burger because that's just massive.
Yeah,
it's just massive.
20 gigawatts of power is probably 4 combined of the current data centers. But I think that tells something for the future build out of AI, because we're hitting our token limits as a small firm here in Consilio on Claude.
Yeah.
And if pulsing our usage, right? And they can't build out the way they need to build out. I think we would see a bottleneck with AI usage, because you're starving these things, right? You can't keep feeding these big data pools, especially if states are jumping on board to saying no to building. And the NIMBYism, I think NIMBYism might be good in this area, because who wants a massive warehouse with rolling jet engines? Yeah. And sucking all the power in the area. But it's what these are needed to operate AI. I don't know. I can't think of any way around it other than launching data centers in space, but that's not been done yet.
That's the story for June, right? Elon's working on that, and maybe if we keep outlawing data centers, we're just going to put them in space. Pushes up SpaceX's valuation.
It has to, right?
It has to. All right. Well, we'll see. We'll see if this keeps playing out. But as of now, my read is meh.
The law just seems written in a way that the power usage would never reach that level, right?
Right. Okay. Cool. Well, tune in a couple weeks when we bring you your next
Talk about
episode
credit
of
again? Yeah.
Private Credit in the News. And that's it. Signing off for now.
All right. See ya.